gentle reminder again that we will be taking questions in the Q&A tab during the Q&A session. So if you have any questions, do put them in the Q&A box and not in the chat box. All right, and then you can also upvote other people's questions. And if you have any questions along the way, do feel free to just post in the Q&A box itself. Right, without further ado, also we will start the sessions soon. Right, for this session, we have Jonathan, Glenn, Ambrish, Zane, and Helena will be presenting on the US big tech, US banking sector, as well as the technical analysis for the US market. So without further ado, let us welcome them, and Jonathan will be starting first.
Thanks, Fansu, and good evening, everyone. Yeah, let me set while I share my screen. Okay, so yeah, thanks for the intro. Like Fansu mentioned, I'm Jonathan, together with some of my other US colleagues, Glenn, Ambrish, Zane, and Helena, sharing a little bit more about the US markets, a little bit about what happened over the last quarter, and maybe a little bit of what we think could happen moving forward. So right here, I put on a picture which is I thought was quite funny. You've got Nvidia here holding up the entire stock market, which technically is not too far from the truth. I just thought that it kind of sets the tone for at least today's session. Okay, so just our usual disclaimer that the information here is solely for educational purposes, and it's the view of analysts and presenters, and not on behalf of the company. Yeah, so just content for this evening session. As always, feel free to just post your Q&As in the tab below. Get to it at the end of everything. Yeah, so just beginning with a quick review of the market performance in the second quarter. You've got this bull over here just taking a chill on the beach. Essentially, that's kind of telling the story of what happened in the equity markets. Also, for the most part, I tried to use generative AI to kind of find and put up some of these pictures, just because AI is a big theme in today's investment thesis. It has been for quite a while. Yeah, so overall, the Mag 7 actually continued to push markets higher. If you look at the two boxes on the left and the right, S&P was up 15%. So this is excluding dividends, it's roughly 15%. The Nasdaq, for the year, in terms of 3 months, it was up about 4%. So the Nasdaq was up 17% and 8% respectively for year to date, as well as in the second quarter. Most of the gains was really driven by the Mag 7 companies. So these your big tech guys, Apple, Amazon, Nvidia, and so on. They're up 31% year to date and 16% in the quarter. If you actually take out the Mag 7 from the S&P 500, S&P probably be up about 7-8% only. And actually would have been down 1% in the second quarter. So, very heavy reliance on the big Mag 7 companies pushing everything up higher. All other asset classes were up slightly, except for fixed income bonds, which fell about 2%. I just want to throw out this chart. It kind of shows, I guess illustrates how much more importance the Mag 7 group of companies have been over the last year and a half. If you look at the beginning of 2023, these 7 companies constitute about only, I say only, but 20% of the whole market index is quite significant actually. Well, then fast forward 1.5 months, this number has grown to almost 35%, it's about 33-34%. So quite a significant increase. Basically, it now encompasses about 1/3 of the whole index. And we don't really see this slowing down. We expect this to continue moving forward, especially as more investors pile into these larger companies compared to other 493 companies. In terms of FX, the dollar continued to strengthen versus most other currencies. The biggest cause for this, higher for longer rates, a stronger economy versus most of its trading peers, especially in Europe, and obviously the yen continues to crumble. In terms of your sector rotation and what happened in the second quarter. There's this rotation back to tech. See Semicons, technology, as well as communications. Communications, well, quite a number of your big tech companies are actually in communications, so companies like Alphabet and so on. While a lot of cyclical sectors like materials, energy, and industrials, which actually performed quite well in first quarter, were the laggards. Real estate continues to be fairly weak due to higher interest rate environment affecting new home loans as well as refinancing and home purchasing in the US. In terms of year to date, AI is still the play. It's still really reaping the benefits. Semiconductor industry is up almost 50%, which is still extremely robust returns. Then you've got the rest of the tech guys up there as well, communications and technology. The only sector that's down is real estate, and the real estate has been poor for the last couple of years. Actually, all of the other sectors other than tech have been lagging the S&P 500. So it just goes to show everything, or most of what's been going on for this year has been due to tech. So when we take a look at some of the valuations, the S&P 500 still looks a little bit overstretched, although they're currently trading about 21, 22 times forward PE, which is slightly above its 10-year average of about 19 times. So it's really just a gauge. It doesn't mean that the S&P is not going to go up any further. It just means that further re-rating upwards is probably going to be quite unlikely. You've got this peak over here in 2020 and 2021 where forward PE really surged quite significantly due to a recovery from COVID. But other than that, it's quite unlikely that forward expectations will continue to climb, at least on a multiple. For tech ratings, on the Nasdaq, it's basically the same thing. It's hitting about 30 times forward PE, which is like the S&P 500, it's about one standard deviation away from its longer term average of 10 years. It doesn't mean that it's not going to go up. It just means likely going to be driven, or at least it's only going to be driven by earnings growth, and not earnings growth plus re-rating outwards to 35 times, for example. In terms of other sectors, we continue to see some value in utilities. It's really the only sector right now that is quote unquote of value relative to its valuations. Right now, it's trading about 17 times for PE, which is still fairly significant. But I think that with yields expected to decline soon, it's really only going to become more and more attractive because of this dividend story. At the same time, with the election kind of coming up, and maybe some of what potentially, if Trump is going to win, some of the policies that is in place, more energy, for example, likely that the main beneficiaries or one of the main beneficiaries could be utility companies. In terms of treasury yields, and we show this every quarter, but essentially what this says is that so the S&P earnings yield is essentially the inverse of the PE ratio. So instead of PE, it's just E over P. And what this just shows is that right now, if you're investing bonds or long-term treasuries, continue to be a little bit more attractive if you're just looking from a yield perspective. So this doesn't really factor in, I guess, growth, quote unquote. But it's just a good chart to show that equities continue to get more and more expensive relative to treasuries. So this is just a quick review of our stock picks from last quarter. So we had Alphabet, Amazon, Microsoft, Nvidia, and Salesforce. Most of them did fairly well except for Salesforce. So really the only one that declined. Alphabet up 20%, Nvidia up 30+%. Just wanted to highlight some of our stock picks from last quarter. Moving into the macro themes, and we have a few similar to I guess the last year and a half or so. Inflation right now seems to be a little bit more under control. Core inflation, the blue line here, has come down quite significantly from its peak of 5.5% to about 2.6%. So very close to the Fed's target. say that their target of 2% long term, and it's actually below the Fed's 2024 target of 2.8%. So it's just really a matter of time, and whether inflation will get down to this 2%, this key 2% level. But it does give us a lot more confidence that the Fed will cut rates at least once this year. Markets are pricing in two, but we're not so sure if two cuts may be achievable. But the key thing here is that inflation is actually not going back up, which is good news for everybody. Yeah, especially after the Fed Chair Powell's latest testimony over the last few days. It's quite clear that at least he took rate hikes off the table, and seemingly is looking more and more right now. Less concerned about inflation and looking more and more at the jobs market. Yeah, so like I said, markets pricing in two rate cuts, planning to end 2024 about 4.85%. And this will be followed by I believe 3 cuts in 2025. Four cuts in 2025 and then 3 cuts in 2025 and 4 cuts in 2026. So that's essentially what the Fed has set out in its dot plot graph over its last meeting. But this is significantly less than market expectations have come down quite significantly. At the end of last year, they were expecting 67 rate cuts, which we never thought was that feasible. Now 2 cuts a little bit more realistic, although really cutting interest rates by 25 basis points or 50 basis points isn't really going to make that much difference to the economy per se, and it just kind of gives stock market investors at least some confidence in the longer term that at least it's going to be policy is going to be easing. It should be good for the stock market. We look at the labor market, continues to ease as well. Unemployment has been rising a little bit from about 3.5% during its pre-pandemic low or post-pandemic low, sorry, to about 4% right now. So it's creeped up a little bit, but still in a healthy range. So this chart just shows the job openings to unemployed ratio, essentially how many job openings there are for each unemployed person in the US. You can see, from 2022 until now, it's been a sharp decline in job openings, which is healthy. But it just goes to show that, and it's kind of close to its pre-pandemic highs of about 1.2, roughly thereabouts. So it just shows that there's some normalization in the labor market, which is good news. You want A, inflation to continue falling, and B, the Fed to start cutting rates. At the same time, we look at wage growth, hourly wage growth specifically. This number continues to moderate from its, I guess, post-pandemic peak of about 6% right now. It's down to 4%. It's coming down, and it's actually helping, I guess, services inflation to come down as well. Although it's still a little bit above its long-term average of about 3%. But at least it looks to be some progress in terms of cooling wage growth, cooling job openings. So moving forward, we look at the US economy. It seems to be cooling. I won't say quite significantly, but it's quite clearly cooling compared to, I guess, over the last year or so. Consumer spending is gradually slowing. This chart just looks at US retail sales. Historically, right now, year on year is down to about 2.5%, which is below its more longer term average of about 5%. So it just kind of goes to show that the US consumer is being a little bit more cautious. I think in the US, prices have gone up quite significantly, while real wages have continued to drop a little bit because of inflation, and so it just goes to show some sort of slowing in spending. At the same time, manufacturing also remains quite weak. It has been a little bit of an improvement over the last year or so, but it's still below 50. The manufacturing PMI is still below 50. Typically, below 50 means manufacturing is contracting. Above 50 means it's expanding. So, since I guess mid 2022, this number has still remained fairly weak. So the combination of weaker spending, weaker manufacturing just leads us to kind of believe that the economy continues to cool And I guess normalized a little bit compared to where it was a year ago or a year and a half ago. So moving on to some of our investment themes, we have four. Well, I guess we have three of them that are really just around AI. And we'll talk about this over here. The first, AI play is semicon. We expect semicons to still really reap the benefits from this initial ramp in AI demand and AI technology. A lot of critical infrastructure is needed for AI. And what we actually tried to do is to find out, how large a potential market was for AI infrastructure. And what we set out to do, we basically used telecom investments as a proxy because they kind of do require similar infrastructure. You kind of have your 5G rollout, you need to build out your networking, your data center capability, so on and so forth. And what we realize is that the percentage of GDP spent on telecom investments globally, it's in a range about 0.4 to 0.8%. So if you just take the mid range, about 0.6% of yearly GDP, and you take this year's GDP, which is like global GDP is expected to be about $110 trillion. You get a rough estimate of about 600 plus 700 billion market sizing for AI infrastructure this year. It could easily reach 1 trillion by 2030. But it just goes to show, how much room there is for growth and potential growth in AI, in the AI space. So infrastructure includes, obviously, semiconductors. It includes everything. When we look at the semiconductor industry in particular, it's almost in a full recovery mode. Halfway through 2024, we're well on our way. The trailing 3-month number, which is in blue, way above 0%, roughly almost 20% year-on-year growth. While the trailing 12-month number is basically reaching a flat right now, but obviously the trajectory is for it to continue upwards and continue growing. Of course, the recovery right now is still fairly skewed to a lot of the AI-related products like AI GPUs, given their higher average selling prices versus other products. Because this chart here is just revenue growth, right? It's not really unit growth. But essentially, it just goes to show everything's in recovery for the semicon industry. Memory and foundry are also in full swing. The only, I guess, real laggard right now is still equipment manufacturers. Mainly because it takes quite a while to manufacture one machine to actually get it shipped out. But it seems to have bottomed as well. So it's signaling a little bit more upbeat news for the rest of the industry. This is just earnings from this past quarter, ending in March 2024. Over the last year and a half or so, it was all processor, it was all about GPUs. Right now, this is kind of shifting a little bit to more your memory guys, Micron, Samsung, and SK Hynix. So they're seeing this huge reacceleration in growth. They're ramping up their high bandwidth memory production to support increasing AI demand. What we expect to see, expect to see equipment manufacturers start to pick up either towards the end of this year or early 2020 or early to mid 2025. But the good news is that recovery is broadening, and that's just really good for the total semicon industry. So another illustration of the skewed semicon recovery, AI GPUs, like I mentioned earlier, still driving a lot of it. Sales right now is about 3x year on year, which is just very crazy. While the memory and CPU, not really that. There's a lot of talk about AI PCs, but we're not quite sure whether that will really impact at least the CPU and the PC market. At least in the immediate term, maybe that could be a more 2025 story. And that's just what we think. Memory, like I mentioned earlier, is still lagging a little bit, but 70% growth is still fairly decent compared to most other industries. But yeah, so just another illustration that a lot of this growth is still really driven by AMD, Nvidia, and all these fabulous GPU guys. So our first stock pick we've kind of changed the format a little bit, but essentially our first stock pick for semiconductors and our only stock pick for semiconductors right now is still Nvidia. We still think they're capitalizing the best on the early adoption in AI. Growth is still extremely robust. Over there, their earnings call first quarter, fiscal year 2025, which is more or less 2024 calendar year. Growth, still 200+% year on year, very significant. Over the last 12 months, it's still growing about 3x year on year. A lot of this is still driven by the same guys, the data center GPU business, a lot of hyperscalers, enterprises, as well as more sovereign nations continue to pour money in building out their own infrastructure and with the need, when you're building out their own infrastructure for AI, there's really only, I guess, one major player, and that's Nvidia. And so all the demand kind of flows there. AMD, AMD does get a little bit of it being the little brother, but most of it, maybe 80+% of the demand just flows to Nvidia. At the same time, margins remain extremely high. Gross margins are 75%. It's higher than the historical average of 60%, and this purely has to do with the fact that their data center GPUs, are just really high margin products and just dragging everything up. In terms of valuations, they're still relatively well priced at about 40 times forward PE. I know 40 times seems quite a lot compared to, I guess, we just talked about the S&P, right? It's 20 times. So it's double that. But it is actually more or less in line with its 10-year average. And when a company like this is growing, at least in the immediate term, their earnings, and they're doubling their earnings this year, expected to double their earnings this year, maybe 50% next year. 40 times forward PE, at least in the next 1 or 2 years, seems a fairly fair price to pay, and not too overvalued. We still think that growth, will be sustained and can be sustained. So there are a few reasons for this. Firstly, Nvidia is building a better ecosystem with more diverse range of products. So they've got their custom chip design, they've got their foundry service, they also do have their software to accompany their AI GPUs. So they're trying to do this sort of, I guess, what Apple has done, AI ecosystem, and leverage that so that they continue to get most of the share from most of their customers. In terms of there are also a lot of longer term investment plans from hyperscalers. That they're firming up. They're continuing to invest more money in data centers and so on. And you've got this new $100 billion US dollar Stargate project from Microsoft that they're pumping in. And so we continue to see a lot of demand, which should sustain Nvidia's growth at least for the next year or so, to the very minimum. And lastly, Nvidia also has a very aggressive product rollout strategy that keeps it ahead of its competition. They even mentioned in their conference earlier in Taiwan, Computex, earlier in June, I believe, or maybe it was end of May. But instead of launching new products every 2 years, they kind of move this up to launch new products every year. Not just new AI GPUs, but also new networking, new switches, and so on, just to kind of keep ahead of the competition. I think that because of these factors, we still really like Nvidia from a fundamental standpoint, from a valuation standpoint, and from a growth standpoint as well. Yeah. So we still have a buy rating on Nvidia with $140 target price. So moving on to our next investment theme, which is digital ads. Title here, waiting on elections. Typically, I guess not typically. Let me back up a bit. What we're seeing is that digital ad prices are continuing to gain strength. They're actually starting to grow again over the last quarter or so in terms of average price per ad, which has not really been seen for quite a while, aside from the pandemic boom. So we think that ad pricing has bottomed out, at least from the end of 2022. Growth has been improving ever since. Given that this year is also election year, increasing political and campaign spending should also be a positive driver for the industry. We think that also generative AI is also helping to improve efficiency in terms of delivering better performance for ads and driving an increase in your cost per clicks for a lot of ads. for advertising, how pricing works, it really just a demand and supply uh, uh, marketplace. The ad impressions continue to grow, so they've never really had a issue with ad impressions. So it's just been a pricing that has been quite weak because as digital ads, the inventory of digital ad and the supply continues to expand to across different countries. A lot of developing countries getting better internet connectivity and so on, and using more digital advertising. That's just been flooding the supply of digital ads, and what we're seeing right now is some sort of stabilization, which is good news for the whole ad industry. We're not sure. We don't think that um, prices will continue to dip. We think that it will continue on this upward trajectory at least in the near term. Like I mentioned earlier, election years tend to vote actually really well for digital ads. In terms of the industry, you're really only talking about Meta and Google, the two main guys. You look at this chart here, 2 times over election years, stock prices continue to climb, and is basically no different this year. Both of these companies, they're up quite significantly, like 20-30% already. And so it's really not it wouldn't be a good time to bet against these guys because of I guess historicals and fundamentals continue to improve for digital advertising companies. So our main topic for the digital ads will be Alphabet. They are the digital ad monopoly, and this has been our topic for I guess the last 2 years now. They continue to grow really well. Growth has actually been accelerating over the last 4 quarters to about 15% year on year, which it's not crazy growth like 30+% or even 20+%, but at least it's stable. Margins continue to improve, and with the continued integration of AI, this just helps to drive better products, better eyeballs, higher monetization of a lot of these products like YouTube Shorts, and so on. Sorry, and also, most of your big tech companies and digital ad companies in particular over the last over 2023, they've been cutting significant amounts of costs, and they still do it right now. So this linear cost structure is actually promoting better efficiency. Operating margins for Alphabet is almost back to its pre-pandemic peak, or rather pandemic peak of 32%. And in terms of valuations right now, they're trading about 22 times. So very in line with the average, but we think there's still room to run given investments in AI to support future growth. In terms of what we expect from Alphabet, we expect earnings growth of around 25% for the next 2 years. Let me rephrase this: a compound annual growth rate of 25% for the next 2 years. And so for Alphabet, the biggest reason why we choose Alphabet for let's say Meta, for example, is because they are the monopoly. They have the most eyeballs, and they continue to improve their products and their cost structure. We have an accumulate rating on Alphabet with a target price of 195 stocks. So that's all from me. I'll hand it over to Ambrish to continue with cloud, and the rest of my team to continue with the rest of this presentation. Thank you.
Thank you, John, and good evening, everyone. So moving on to our next theme, which is AI is fueling cloud computing demand. Next slide, please. So cloud computing, it basically means that companies, they are relying on cloud service providers to meet their computing needs, like networking capabilities or storage or server capabilities. So the three main cloud service providers are Microsoft Azure, Amazon's AWS, and Google Cloud. So just as an example, so Netflix, it heavily relies on Amazon's AWS for its computing needs, and so basically it does not invest in its own data centers, and as a result, so it's able to reduce a significant amount of upfront costs, which is upfront costs, which might be needed to build and maintain an IT infrastructure. So basically companies, they rely on these providers mainly because of flexibility, and also higher enhanced securities and performance capabilities. So according to Statista, public cloud revenues, they are expected to grow by about 21% CAGR over the next 3 years. And we believe that there are two key growth drivers for this. So first of all is that as the digital transformation trend, so as companies they digitize their operations and they shift their workloads from on-premise to cloud, so this should give a boost to computing demand. And second reason is that so as more and more companies they integrate generative AI technologies into their existing product base, or if they plan to have a generative AI into their system, so they basically have to rely on more powerful computers which can run the AI models, as well as they can analyze vast amount of data. So we believe that as a result, AI could be fueling the cloud computing demand over the next 3 years. Next slide, please. So big tech companies, they have been investing billions in AI, and it has increased. So if we take a look at the orange line, so the capex, this is the capex spending for Microsoft, Amazon, and Google. So the capex capital expenditures, they have significantly dropped in 2022, and this was mainly because of macro uncertainties like high inflation, and so basically supply chain constraints, geopolitical uncertainties. So as a result of macro uncertainty, companies they have had reduced their IT spending, and as a result, the capex had dropped. But over the since second half of 2023, it has been an uptrend, and in the first quarter of 2024, capex spends by these three hyperscalers, they have increased by about 40%, and they expect to continue rising over the next year or so. So they basically are investing monies into building or upgrading their data centers, and also like procuring specialized GPUs or chips from Nvidia and other players, so which can basically run the AI models, and basically be able to use them for AI training AI models. So we believe that the surge in capex should help it could lead to higher revenues for the cloud companies, these players, mainly because investment, it would basically expand their capacity, infrastructure capacity, and as a result they could earn more. And secondly, also with the enhanced performance capabilities, new customers might be attracted towards these services. So moving on to next of topic for cloud computing segment. Next slide, please. So we have Microsoft. So the title is Azure is gaining market share. So if we take a look at the blue line, so it's the intelligent cloud segment revenues. So it has been the fastest growing segment, and this segment it basically includes Azure service. So Azure, its market share has been consistently increasing from it has doubled over the last 5 years, and it has increased from about 23% last year to 25 right now. And whereas Amazon, it has AWS has a market share of about 31%. So we believe that Azure, it can continue to gain market share mainly because of the digital transformation trends, as well as its integration capabilities with Office 365, and also the company claims that it's 5 times cheaper as compared to AWS. And also the enterprises, they get access to the pre-built AI models from Azure, and as a result they can integrate those AI solutions into their across their product base. So for instance, if they can if a e-commerce company wants to put up a chatbot into its website for orders or returns. So they basically they can rely on the Azure AI service, and over the last 3 quarters, Microsoft had said that it's gaining traction for its AI solutions. The second growth driver for Microsoft, we believe, is that it's Office 365 productivity software. So despite 90% market share in the productivity market, the commercial revenues for Office 365 it has been consistently increasing by about 15% year on year each quarter. And this is mainly because of continuous product enhancements and also rising need to manage tasks and workflows. So and companies, it has also highlighted that it's gaining traction for its co-pilot generative AI, it has integrated into its Office 365. And in terms of the more personal computing segment, which is in the red line, so it basically dropped last year mainly because of weak demand for personal computers, whereas it has rebounded over the last 2 quarters. And we believe that this is mainly because the recovery in PC shipments, and its gaming segment revenue, it increased, and mainly because it mainly because it witnessed higher player engagement on its gaming platforms, mainly because of addition of Activision Blizzard gaming titles like Call of Duty. So overall for Microsoft, we have an accumulated recommendation and a target price of 465. So just as a side note, our target price, it's near the current market price, and we would be updating our estimates, and we will be revising our target price once the company releases its quarterly earnings report by the end of this month. So that's all for me. Would now like to pass it on to Helena for Amazon.
Thank you, Ambrish. Good evening, everyone. I'll be touching on Amazon. So just like Ambrish has shared earlier, the AI has most definitely been driving a lot of boom in the cloud. So another company that benefits quite a bit would be Amazon. So for Amazon, their AWS revenue growth has been dipping in FY23. Their growth in FY22 was great. It was really surpassing 20%, even 30% year on year. Yeah, starting from the first quarter of 2023, it starts dipping to 15%, then 12%. This is mainly due to consumers moderating their spending. During the hard period in COVID, where survival is the priority, the first thing they pull the plug on is innovative pioneer projects. So migrating workload from on-premise to cloud, that is something they can wait for. It does not really affect their existing business, which is why AWS took a hit for the first few quarters in FY23. But in the last quarter in FY23, we're starting to see the effect bottoming out. And the recent quarter, which is the first quarter of FY24, we are safe to say that we're definitely seeing more signs of accelerating now. So AWS revenue growth has reaccelerated back to 17% year on year. Customers are really migrating their workload from on-premise to cloud. It's either new customers who start a new initiative or existing customers who stopped previously due to their cost cutting. So they're all slowly coming back. And we think there's still very significant growth headroom ahead. I mean, the scene of AI is going to be at least a 3 to 5 year scene. And right now, over 85% of the global IT spend still remain on-premise. So which means if everyone start migrating their workload from on-premise to cloud and eventually using cloud becomes the norm, imagine how much potential there is. If you take a look at the market share, AWS right now still remains number one in the industry. Their market share is around 30% compared to Microsoft's 25% and Google's 11%. So this has definitely given them the edge. It allows them to attract new customers, and at the same time makes it harder for existing users to switch to another cloud provider due to the trouble procedure and the cost involved. AWS revenue currently only accounts for 17% of the Amazon's revenue. But will it keep increasing sequentially? I mean, currently its growth rate is reaccelerating again, so we're confident for it to reach above 20% soon. So this will be a much faster increase compared to Amazon's retail sector, which means it's going to take up a bigger portion of Amazon's overall revenue. And this will help significantly for Amazon's margins because AWS is an extremely high margin segment. Its operating margin is as high as 38%. Compared to its retail margin, which is only single digit. So the real kicker will come from margin expansion, where AWS takes up a bigger portion of the entire revenue. Amazon is already seeing a significant margin expansion from only 2% in the end of 2022 to now 8%. Of course, partially, this is also thanks to their efforts in regionalization and cost cutting in the e-commerce sector. But AWS expansion is definitely playing a big role in there, and we believe there's a much bigger role in the future. On the other hand, management has disclosed that there will be a significant increase in CapEx for 2024 in order to booster the AWS growth, in order to keep up with the existing demand. So such increase is already on the way. In May this year itself, the projects they have announced to boost cloud infrastructure worldwide is around $40 billion US, which is quite a bit. If you compare it to their capex for 2023, the entire year is only $48.4 billion US. So there's obviously a big increase. With that, we still remain very positive on Amazon. We have a buy recommendation with a target price of $220 US. That would be all from me. Now I pass my time to my colleague Glenn to talk about US banking.
Thanks, Helena. Yeah, so for the US banks, we titled it Navigating Higher for Longer Rates. Because rates are with expectations of it, sort of not having any cuts soon, right? How will these higher for longer rates actually benefit or for the banks, or even in some case, right, we are looking at it being detrimental for the banking sector. So the first slide here, we have it. It's just a brief review or recap for the first quarter results. We have put the 4 largest banks in the US. So we cover 3 of them: JP Morgan, Bank of America, and Wells Fargo. So I've just included Citibank here as it seems to be the one that actually has quite a lot of interest. So for the net revenues, you can see it's rather flat. JP Morgan is really the only one that showed sort of any growth in their revenues for the first quarter, at least year on year, whereas the other 3 are more like stable or rather flattish. And this came from a decline in their net interest income. So what we have seen, at least for the 3 banks, the 3 of the 4, is that net interest incomes as well as the net interest margins have started to stagnate. Right, the growth has slowed down from right after COVID, in 2022, 2023, when growth was extraordinary with their net interest income, and net interest margins. We have starting to see it slow down, mainly due to the cost of funds creeping up and their asset yields actually not holding up as high, not growing as fast, right, as it was previously. So that I'll go further into that in the next few slides. And what was the growth driver then for these banks? And it would be the non-interest income, more specifically the investment banking. So investment banking has done a very huge recovery for all the banks, not just these 4, but majority of the banks that have a sort of a large investment banking segment. And I think this is mainly due to a recovery in the sentiment as well as the market sentiments. So we have seen this big growth, all double digits, even Wells Fargo showing a 92% increase. Trading, on the other hand, has not really done as well. So it's, a negative or just a very low single-digit kind of growth. The other interesting point I'd like to look at would be the provisions, right? Provisions change. So this figure here, it's just showing year on year how much provisions have increased or decreased. So majority, you can see that provisions have actually went up. And, it might be a bit of a worry. You're thinking, oh no, does that mean that more of their loans, it's not doing as well, that's why they have to increase provisions? I think it's not that case. It's more of a stabilization and back to normalization of provisions. So although there is an increase, right, we're not seeing it really surpassing pre-COVID levels, pre-pandemic levels. And loans has also been pretty stagnant. I have a slide on that later, but you can just see from here, if you compare across the board, it's all low single-digit loans growth. And last but not least, you look at the last red box here, we can see the PATMI growth or the earnings growth. Only JP Morgan has actually done well, and this is mainly due to the net interest performing well. Because if you add back in the First Republic acquisition that they did, right, they actually did pretty well, and this bumped up their earnings. Whereas the other banks, they were really hurt quite badly by the net interest margins decline, as well as very slow loans growth, which also did not help their net interest income. So moving on to the next slide, this will just be a rough. We're looking at three factors that will influence how the banking sector will perform in the following quarters or for the rest of the year. Firstly, you like to look at the bank's performance against the Fed funds rate. So interest rates are a main determining factor for the banks, right? It really shows how well they will do in their earnings, and also, if you look at it, their share price as well. So we compared the Fed funds rates against the Dow Jones Bank Index, and you can see, if you look all the way back to this goes all the way back to 2000, right? The banks really benefit from higher rates, when anytime there is a huge rate increase, we will see that the performance for the banks has actually improved following the Fed funds rates, right? The rates. However, what's interesting was that in 2022, all right, where 2021, 2022, the rates did not increase much, right? We saw it flat, and that was like post-COVID, they were still recovering. They haven't really increased much. But why did the bank's share price actually go up so high? And that's because loans growth was extraordinary because they were lending at really low interest rates, and their loans growth was like double-digit figures. Hence, we saw the bank's performance as well as their earnings increase in tandem with that huge loans growth. So if you're looking at does it really tag along with the Fed's rates? How does it follow? I think in the last few years, it hasn't really followed closely with how the rates are heading towards. You can also see, all the way in like recent times, like 2024, you can see that while the rates have been stagnant, the bank's performance has been improving. So with rate cuts, if there's any potential rate cuts going into the rest of the year, we feel that there are several reasons why we think this will be actually beneficial to the banks instead of detrimental. So the next slide will show why we feel that the banks can benefit from an expected rate cut in the later part of the year. And that's because, as I mentioned earlier, the cost of funds have been creeping up. Let me explain this slide, this chart a bit first. It might be a bit confusing, but the green bars are basically the bank's net interest margins, while the blue line here is the asset repricing growth, and the orange line there, that is the cost of funds repricing, sorry. So if you look at the bank and how they do their business, the asset repricing, basically it's showing how much they earn from how much they earn from lending out their lending loans, or even putting it into different kind of assets. So that is how much they earn. Whereas the cost of funds repricing is basically their cost of funds. So the difference makes up their NIM. And we have seen, in the 2022 period, 2023, the start of 2023, we can see that the asset repricing the growth was surpassing the cost of funds repricing by a lot. Hence, you can also see that their net interest margins also grew in tandem with that growth, with that difference, right? But what we are seeing recently, or at least in the last 2-3 quarters, is that the cost of funds have started to overtake the asset repricing. So we are not really seeing any growth in NIMs because the asset repricing has been kept. The rates are not going up any further, but it's sort of like maintained at these high levels. So what's hurting the banks right now, it's their cost of funds are slowly creeping up, right? To retain customers, or to be more competitive in the market, they need to give better rates to the customers. Hence, they are slowly going up and going up. So actually, a rate cut for the banks might be good because then they can lower their cost of funds, like their deposit rates to the customers, and this might invert in the future if there are any potential rate cuts. So that's one of the factors we're looking at. The second one, it's the loans growth. So the next slide, we are comparing the loans growth to the nominal GDP growth. And in essence, what does this mean? It means that we always look at this graph, in a big picture, and we'll see that if the loans growth is slower than the nominal GDP growth, it would mean that the banks are not over-lending to consumers, and also the consumers are not over-borrowing. So they're not taking on more than what the economy is growing, or taking on more than what they should, which it sort of shows whether there will be a recession or not. So you look back at 2008, that's a very interesting figure. Look at 2003 to 2007. So you can see the orange line, which is loans growth, is way higher than the nominal GDP growth. Hence, it could be an indicator of how strong or how resilient the bank's assets are. And then that eventually ended up in the 2008 global financial crisis. However, if you go back to the present, you can see that the loans growth has been rather slow, and it's actually slower than the nominal GDP growth. Even now, loans growth is very low. It's like low single digit. We also feel that it's rather slow and stable, so that's a good sign. The banks are not over-lending, so we can be sort of like we are less cautious on their provisionings or even their non-performing loan ratio. And also, there is also some upside. Once the rates come down, their loans could possibly pick back up to better times when rates were slightly lower. So that is another driver for the banks. Basically, their earnings, it could benefit from the loans growth. So those are the points I have for the banking sector. I'll now hand it over to Zane for his TA. Thanks.
Thanks, Glenn. I'll now talk a bit first about some of the data regarding US presidential elections, looking at the historical returns pre and post election, then followed by some TA on the Nasdaq and S&P 500. Next slide, please. Now, so first slide I have is that to show the election year seasonality for the different months. And then for this year, we're actually seeing an outperformance compared to the average election year. So first thing I'll talk about is the blue bar, which is the average returns every month for the S&P 500 since 1928 for election years. Why I use 1928 is because since 1928, there's consistently been a two-way contest between the Democrats and the Republicans. And then, so we can see that for the blue bars, we see the strongest returns during the summer months, which is during June to August, with a return of about 4.4% to about 3% in these 3 months. And then we also seen strong months, particularly after the election has concluded in November and December, with returns about 1 to 1.5%. And when we take a look at the green line, which shows the probability of a month being in the green during the election year, we can see that for all the months, January to December, on average, it has been over 50% chance that a month has ended up in the green. So you can definitely say that election years are definitely leans more towards positive for the S&P 500. Yeah, and then we look at the orange bars. This actually shows the performance this year every month until June. So we can actually see that there's a lot of large orange bars in the green. So we are seeing a very strong election year this year, especially when we see that for February and for May, they actually defy the usual election year slight dip as compared to the blue bars. Yeah, so for this year wise, we're actually definitely seeing a very strong election year, where S&P is up about 18% year to date. Next slide, please. So next slide, I'll talk about what are the election year returns when a Democrat is elected versus a Republican is elected, as well as in all the years. So this chart actually shows the S&P 500 presidential election year average returns, also since 1928, when these three scenarios play out. First up, when in all the years, we actually expect about a 7% return for S&P 500, about 75% of the time. And then when a Democrat is actually elected, we actually typically see some of the lower returns being generated, with only about 4% return for S&P 500 during the election year, and in terms of the number of years being positive is about 60%, as where for a Republican is being elected, we actually see the strongest returns. About 90% of the time, there is a very, very high likelihood that the S&P 500 will end up in the green. And then the typical average return is about 11%. So definitely when we look at when the Republican is being elected, it's more than 2 times as the S&P 500 performs more than 2 times as strong as when a Democrat is elected during the election year itself. Next slide. So the next chart I'll talk about is what are the kind of historical returns pre and post election day. So I've used some milestones such as 3 months, 1 month before election day itself, 1 month, 3 months, 6 months, as well as 12 months post election day. So we can see that for the 3 months and 1 month pre-election day, actually when the Republican is elected, the S&P 500 actually usually does better with about 1 to 2% returns, as compared to Democrats is about 0.3%. On election day itself, is rather flat. As we move past election day, we can see that the Democrats actually do better. So there's a difference in performance pre and post election day. So especially when you look at the 3 months, 6 months, and 12 months, the longer time frames, 3 months we are seeing about 2.5% return on the average when Democrats elected. Then that goes up to about over 6% over a 6-month period, and then after a year it's about 12%. Then when you look at, whereas when Republican is elected, the 3 month return is on average about 2%, 6 months about slightly higher, about 3%, and 12 months is about 1%. So yeah, there's a divergence in terms of the performances of the S&P 500 pre and post election day when these two parties are being elected. So yeah, something interesting to look at. Next slide. So the next slide is that currently I want to look at what's the historical returns when Democrats stay in power versus when there's a change in power from Democrat to a Republican. So I saw that when Democrats continue to remain in power, this is linked with higher returns in future. As we can see that similarly after the 3-month mark, when Democrats stay in power, that they actually generate quite good returns, about 3 to 4% at the 3 to 6 month mark, sorry. And then at the 12-month mark, it's about 7%. Yeah. And then whereas compared to Republicans, the returns are actually more lackluster, not exceeding about 2%. So that's something interesting as well. Next slide, please. So the next one is I want to talk about the Trump basket as well as a battle for Congress. So as I think as we all know, the current favorites to win the race to the White House is currently Trump. And then in Democrat side, there's actually some stumbles going on. We might not even sure whether Biden will be running for the race in November or not. So we're looking at if Trump is being elected to the White House, what are some of the sectors or some of the stocks that we should actually pay attention to? The first sector is actually the financials, because actually Trump plans to actually deregulate the industry further. And then the second one will be traditional energy, which is your big oil, where Trump aims to actually increase energy production with drilling on federal land. And also with Donald Trump being pro traditional oil as compared to renewables might actually take a bit of a hit if it's in power as well. And the third one is actually the defense sector, where Trump has actually vowed to increase defense spending, also to tighten up border security. So this sector will definitely come into play as well. Fourth one is that his own Trump Media Technology Group Corporation. I'm pretty sure this stock will actually come into quite a bit of focus if he gets elected. This stock could potentially get a boost if he actually uses this platform during his presidency, and they'll also draw a lot of eyeballs and attention towards his platform as well. And then the fifth point is that with Trump in power, he has also vowed that he will impose about 10% tariff on all imports into the US, with a 60% or more tariffs on Chinese imports. So that will be actually a key thing to note as well. As for the battle for Congress, currently there's about 50% chance of a red sweep, meaning there's a 50% chance that the Republicans win the White House, and then the Senate and then the House also belongs to the Republicans as well. So what kind of implications does that bring to the market? So with that, with a red sweep, it makes it easier for the Republican Party to actually pass through policies, and that will actually might bring about some market uncertainty, as well as a higher bond yields with the tax cuts and tariffs that he plans to propose. And then actually the market actually prefers a divided government where there's a mix between Democrats and the Republicans, where there's less uncertainty as the incumbent party is harder to push through some of these policies. Yeah, so with the battle of Congress going on, I think this is something to look at as well. Next slide, please. Next one, I'll move on to the technicals for Nasdaq as well as S&P 500. The next slide. So for outlook of Nasdaq, currently Nasdaq is very strong. It's currently heading towards this main uptrend channel resistance highlighted in blue. Also, this is also confirmed with a trendline resistance in black as well. So from this level, we might see some sort of a consolidation of a slight pullback as we have seen in prior instances back in August last year, yeah, as well as October 2022 as well. So at this area, we might see some consolidation, but overall, it's likely to still continue its uptrend trading in this uptrend channel. So our third quarter target will probably be about 17,500 to about 19,000 area. Next slide, please. Next one is the outlook for S&P 500. So for S&P, it's also done very strong this year. Currently, it's trading within an uptrend channel since breaking out of the 5,265 previous swing high level formed in March. And yeah, so with that, we are likely to see continue strength for S&P 500 going into third quarter, which could bring about a target of 5,700 to 5,900. Yeah, so that's all from me now. I'll hand over to Jonathan to move on to the next slide. Thanks for our stocks coverage.
Yeah, thanks, Zane. So this is just a update on our stock coverage. Right now, I think we have close to 20 stocks. 3 of the banks and the rest in tech. Yeah. Okay, just to conclude, before we go to Q&A, we'll continue to see Max 7 drive markets higher. Which is a good thing because these are your biggest and best companies, at least fundamentally, for the most part. Though we do also see breadth continue to improve amongst the rest of 493 companies, which is also good news. So all in all, I guess a win. We still believe that we are kind of in a secular bull market that could last maybe 3 to 5 years at the very least. I think AI is obviously a big reason for this, but at the same time, profits are also improving for a lot of S&P 500 companies. Although it wouldn't be a surprise to us if we experience a pullback sometime in the third quarter this year, and then hopefully end of year. Inflation, we think, is under control. Obviously, interest rate ceiling is basically capped. That one is well documented by Fed Chair Powell. But what we see right now is the 2024 narrative, at least for the US market, shifting away from whether or not we can tame inflation, and shifting more to your election outcome, because there's a little bit more uncertainty there, at least on the part of compared to how inflation is going to be doing. So we think all in all, fundamentals continue to improve. We're still quite upbeat about equity markets for 2024, and this should be a good driver at least for the rest of the year. So that's all for us today. You can go into the Q&A. And we'll just start taking some of the questions, at least the most upvoted one. So far, there's only two that is upvoted, but we'll just kind of go down the list. Try to answer as many as we can. Yeah, so the first question here is Nvidia still can buy. Actually, there's another question on Nvidia about the target price. Nvidia is now $135. Target price is $140. Is it still a buy? So the short answer is yes. We think Nvidia fundamentally is still in a very good place. The demand continues to be very robust. There's very little, at least in terms of visibility, there's very little that it can really derail the Nvidia train. So the main thing will be, right now at least, be driven by how well earnings do, how well the supply ramps for their AI GPU chips. Obviously when we did the recommendations, it was a little bit earlier in the year. But we still think fundamentally these companies, our 4 stock picks for this quarter are really strong. We still think that at the very least they will continue to outperform the broader market in this upcoming quarter. So hope that helps. answer some of your questions. There's also a question here on, actually, there's a question on what's the difference between buy and accumulate. So basically, how we measure buy and how we measure accumulate is how much upside there is at the time of our recommendation. So we actually have 5 ratings, right? We've got sell, reduce, neutral, accumulate, and buy. So neutral would be if it's fairly valued and the upside is from -5% to 5%. Then accumulate would be from 5.1% all the way to 20%, and then buy is more than 20%. So you could basically say accumulate is a buy and then buy is a strong buy in more layman terms. But yeah, I hope that helps. There's another question here. I'll try to take this. Statistically, in the last 2 cycles, market peaked when 30% or more of portfolio are invested in equities. It's currently near 34%. Are we trading too close to the winds? What is your expectation for the Dow Jones, S&P 500, and Nasdaq peaks or near peaks? Okay, so I guess this cycle maybe is a little bit different from the last 2 cycles. It's very different in terms of fiscal policy, even monetary policy as well is a little bit different. But I don't think that would be a ceiling to equities. I think in terms of our expectations, maybe not so much for the Dow Jones, but for the S&P and Nasdaq, we think that we should at least hit new peaks by the end of this year. So I wouldn't call where we're at the peak because earnings are only actually improving. So if you take it at face value, if there's no derating and earnings continue to improve, then theoretically we shouldn't actually be at the peaks as of right now. So hope that helps answer your question. I'll take this question before I pass it on to Glenn. So apart from the Mag 7, what other stocks that you will recommend? Okay, so I guess broadly speaking, I think semiconductor stocks, basically pick whatever you want. Should do well. Even the non-Mag 7 guys, right? That includes AMD, even some of your ASML, Applied Materials, TSMC, obviously. If you go slightly further down, maybe I guess SMCI, Marvell. Generally, semiconductors would be the pick of 2024. I think when you look back next year, like why we need to just invest in these companies. Other than that, like I mentioned earlier, when we look at sector utilities, we still think quite undervalued. There's a lot of upside because rates coming down, and some of the policies that maybe Trump, if elected, encourage, will boost that sector. Maybe I'll go back to the coverage slide and just see from this essentially our stock coverage. Yeah, so I hope that helps. I think that's all for me. Maybe I'll hand it over to Glenn to kind of take some of the questions or any of the other colleagues. Thanks.
Hey, thanks, John. Yeah, I think I'll take some of the questions. This one about a preview. Let me see. Yeah, tomorrow the US banks will begin their second quarter reporting. What is your broad preview on their performances? Yeah, that's a good question. So, I expect nothing much will change, right, from the first quarter. But we might, in a change in the sense that the direction won't change so much. So what will be improving would be their investment banking segments. What will not there, stagnant, I think loans growth will be rather flat. And what would be declining or what would be negative? I think that is the main question. So that would be the net interest margins and net interest income. So majority of the banks will have a poorer net interest income performance growth as compared to the previous few quarters, if you compare it year on year, actually. So why is that so? I mentioned earlier, because of the higher for longer interest rates, that's very detrimental for the banks now. Their cost of funds have been have been increasing steadily, while their asset yields have been declining at a slower pace, but still declining. So we have reached that, that cross section, where it has overlapped, and it doesn't seem to have any end in sight because rates are not expected to be cut at least until the later part of the year, or maybe in third quarter, hopefully, or in the fourth quarter. Yep, so that would be quite a big hit for majority of the banks. I feel that, I think that will lead into the second. There's one more question regarding the banks. The question is, what is the top picks for the US banks and target price? So our top pick would be JP Morgan, right? So we have a buy call on it. Someone also asked that JP Morgan is near the target price. No, so our target price is $231 US dollars. So it's still a buy call. Yeah, that's why is it our topic? Mainly due to their rather healthy and strong net interest income guidance, mainly due to their acquisition of First Republic, as well as them being able to maintain higher net interest margins as compared to the other banks, right? Also, their market share and their size enables them to be able to sort of command a better sort of net interest margins, compared to the other smaller banks who are just sort of like trying to play catch up with JP Morgan. So size does help in this case, right? Being the biggest and the largest does help the JP Morgan grow faster and stronger. But will they take a hit in their net interest incomes? Yes, I think they will still, feel it, right? A bit of the negative effects from the rates. But I don't think it will be as drastic of a decline as compared to the other banks. So we do cover Wells Fargo and Bank of America as well. And even if you add in Citibank, I think the other three banks will probably feel it a lot harder than JP Morgan. But the positives will of course be, investment banking is making a strong recovery. So that would be a good thing for the US banks. Check if I have any more questions. I think that's all for me. Okay, I think there's another question. This is a general question, right? Asking about the hold on, let me find that question. Asking about our rating system, right? How do we do the rating system? So basically, we have 5 different kind of recommendations, right? It's buy, accumulate, neutral, reduce, and sell. So for buy, it means that the returns, total returns, so we include dividends and our target price, it's more than 20%. So, you compare it against the current share price. If that figure is more than 20%, then that is our buy call. So that's our strongest call that we have, is a buy call. And then it goes down to the accumulate, which means that the range, our target price and dividends, the range falls between 5% to 20%, and that is an accumulate call. And neutral means that it's plus 5% to a negative 5%, that's an accumulate. And then reduce, is just the inverse of the accumulate and buy. So reduce will be -5 to -20%. And then sell means that it's more than -20%. Yeah, I hope that clarifies for those who are asking. I think there were a few questions on that, so I hope that answers your question. I'll hand it over to the rest of my colleagues for the other questions. Thanks.
Thank you, Glenn. So let me take on a few questions. So there was one question like, is Microsoft fully valued at $465? So basically, we usually update our target prices once the company releases its quarterly earnings report. So we would be revising our target price on Microsoft by the end of this month. So, but in terms of outlook for Microsoft, we believe that it is well positioned to benefit. Like it's witnessing strong demand for its cloud service, which is Azure, and it has been growing its market share as well as a strong demand for its Office 365, and also Microsoft, it could witness a recovery in its Windows revenues, mainly because of the recovery in PC shipments, and also with the AI PCs launching in by the end of this year or in the second half of 2024. It should also lead to like a recovery in PC shipments as users they upgrade their personal computers to better performance for longer battery life. So yeah, so hope that helps. So there was another question with respect to Block. So which is Block a buy? So Block, it's basically a fintech company, and it basically operates through two key segments, which is its cash app segment, which basically provides personal finance and digital banking service to its users. And basically, it's basically alternative to traditional banking service, as it provides a savings account or a ATM card, and also users can transact or invest into equities and cryptocurrencies. So the number of users for the Cash App segment, it has been increasing, and it has about 50 plus million users right now, and it's witnessing a high engagement within its platform. So and the second key segment is its Square segment. So it basically offers hardware and software solutions to merchants to receive payments from the consumers. So basically, it's witnessing right now. It's witnessing a deceleration growth in this segment, mainly because the transaction volumes have been lowering as the consumer spending is under pressure right now. But once it recovers, it should help Block. And Block, overall, we have a buy recommendation on that with a target price of $96, and we believe that it should benefit from a shift to cashless payments, and also like a shift towards cashless payments. And also it's witnessing a strong demand trends for Cash App segment, and its unique proposition is that it mainly targets the underbanked population, so who can't open or not able to open a bank account at traditional banks like maybe JPM or Wells Fargo. So overall, we have a buy recommendation for Block. So hope that helps. Would pass it on to the rest of my colleagues.
Okay, I'll take some of the questions. There was one on C Limited. So C Limited has been seeing quite pretty well-rounded growth. For their Shopee sector, their Shopee growth is quite stronger than expected. It grew 33% year-on-year in the last quarter. Their gross order and GMV both grow significantly at 57%, 36%, which is quite a bit because considered 2 quarters ago, it was only like 13% and single-digit GMV growth. So this is definitely quite a bit. But what remains questionable is because they're increasing a lot in their e-commerce spending. Ever since the third quarter in 2023, they have almost doubling up their sales and marketing spending for Shopee, in order to fend off the strengthening competition coming from TikTok shops. So we're not really sure whether this is a bot increase or whether the fundamentals are actually getting better. So the sustainability is a little bit questionable. Moving on to their gaming sector is seeing strong growth. The bookings were up 11% year-on-year, which is the highest in the last few years. Additionally, we can see strong increase in all the user metrics like QNU, QPU, both have been surging, which ended the 2-year trends of decline and slow growth. So the acceleration is because gamers, they're finally returning back to gameplay after 2 years of fatigue period, because during COVID period, everybody did too much excessive gaming, so they kind of get tired of it. So that fatigue period actually run out. So we're starts to seeing gamers slowly returning back. So we do anticipate the gaming matrix to increase double-digit moving forward. So that is pretty optimistic. So overall, we have a neutral rating. We have a neutral rating of C with a target price of $75. This is because they have a recent share price gain. There's another question. Can't find it. Basically, it was a question on Apple, like, is this still a buy? The Apple right now, we're actually downgraded to a neutral rating because right after the WWDC, their share price went up quite a bit. So during their WWDC, we still think that it is pretty optimistic because previously, during the last earnings, it was a little bit, people are a little bit not sure how Apple is doing because they're really lag behind in terms of their AI announcement. But their WWDC, they came up with an entire range of Apple intelligence, which I would say is very revolutionary. So it basically changed the entire way of how we use the phone. So the most way it impacts is because it's only compatible with iPhone 15 Pro and iPhone 15 Pro Max. So we think it would likely trigger a new round of replacement cycle with people changing to the new phone in order to be able to use the Apple Intelligence. There are also synchronization features saying, oh, you can now use the MacBook to synchronize together with your iPhone. So we do foresee that it's going to increase the product demand for other products as well, as people are going to be more motivated to buy a MacBook to pair with their iPhone, or an iPhone in order to pair with their MacBook to enjoy the synchronization benefits. So that's definitely something worth noting. I think one thing that might set them apart in this AI race is their focus on privacy. So Apple emphasized they're going to protect user data. They're going to give user control over the data because most of the tasks will be run on device. And for the tasks that's a little bit more complicated, they will be running on their private cloud, which they promise that they will have no access to the data. But exactly how it's going to roll out, we're going to have to see once it rolls out whether it is true. But we believe if they're really doing this privacy-focused entry, it can actually serve as a significant differentiator to their other competitors. Because first is Apple, they have a long reputation of being the most private and secure conscious companies. And second is because unlike their other competitors like Alphabet, Meta, and Amazon, Apple's profit mainly came from their hardware sales and services, so they're not really dependent on collecting their user data. So we think that is something that might potentially set them apart. So overall, we did increase their target price to $220, but given the price increase, our rating remains neutral. So I hope that answers your question. I think that's pretty much for me. I'll pass my time back to my colleagues.
Yeah, thanks, Helena. I'll take a few more questions before we back to Zane to do some TA and can wrap up. Yeah, so there's also this question here. You know, Apple and Tesla have rallied quite a lot recently. Still by I think Helena just mentioned talked about Apple. Talk a little bit about Tesla. There's another question. You know, target price for Tesla is $145. Yeah, so Tesla actually gone up like probably 35% in the last week or 2 weeks, which is pretty crazy. A big part of it is because delivery numbers were a bit better than expected. But it's not really saying much because you know, the expectations were so low. It's going to be quite difficult to get any worse. But essentially for Tesla, you know, it right now how we value it's still a car company, still a manufacturing company. You know, a lot of the software margins haven't really kicked in yet. And so when you look at a company, pricing is coming down, volume is not increasing, or volume is flat, pricing is coming down, margins are coming down. It's really not much optimism in that sense from a fundamental perspective. Look at some of the valuations as well. Right now, I think they're trading 80, 90 times forward PE, which is quite a lot. And so, you know, we've had this call for a number of quarters already on Tesla, mainly because there's a lot of competition, especially in China. We just don't think that, you know, as a car company, the whole industry is not really growing as fast as it once was. And your margins are improving, your earnings are improving. Then it's very little to be desired, at least in the near term. Yeah, I mean, when you talk about long term, if and when you know the full self-driving and a lot of the software margins kind of kick in, then obviously there's a different story to evaluate accordingly. But right now, as a car company, pretty steep valuations. I think you just look at some of its competitors like BYD, right? They're growing faster, volume is better. I think they're trading at 15 times for PE. So the disparity there is quite significant. If you're paying a lot of quite a premium for Tesla for a company that, at least in the near term, doesn't really have much upside compared to the BYD. Yeah, hope that helps to answer your question. I'm trying to run through a few more questions here. What's the target price for AMD? I believe it's 195. What's your view on investing in Bitcoin ETF? So I guess if you know, the Bitcoin ETFs have made it a lot easier for investors to gain access to an alternative asset class, without actually investing in the Bitcoin, which is a bit troublesome because you go get your Bitcoins, get your own wallet, go on an exchange like Binance or Crypto.com. You got to be afraid that they may or may not crash, and then you got to convert your cash into whatever crypto you want, and it's just very troublesome. Whereas if you really just want exposure, the Bitcoin ETFs are a great way to at least gain exposure at a relatively low cost and a very liquid investment. Yeah. One more here. The CPI data just came out a few minutes ago, and inflation is better than expected. Yeah, I think it's 3.1, 3.3. Sorry, let me take a look. Versus 3.4. 3.3 versus 3.4 expected. I don't think there's really much implication because the expectations right now is for inflation to come down. So as long as it does come down within the range, right, plus minus 0.1% year on year, it's unlikely to really move markets. Obviously, if it comes down a lot steeper, then you probably start to see markets move a bit more. But if it's within the range, I don't think there's really any implication to the numbers. That's why I mentioned earlier that probably job numbers probably a little bit more important, as well as election outcomes moving into the second half of this year. Okay, I'll take one more question here. What would be the next star, ARM, Marvell, or Supermicro? So in my opinion, I think ARM will probably be the next star. They are essentially what they do is essentially like Nvidia, but for the x86 PCs, right? And look at the growing AI PC market, there's a little bit more potential. You can even, I think I read somewhere that they honing in on the mobile market. And so when you think of where the expansion is going to be, other than the AI GPUs, right? You also have the CPU portion, and the architecture, and that's probably where ARM will excel in. So I think ARM will probably be the next star. Yeah, hope that helps. Sorry that we couldn't really answer all the questions. Still about 30 questions that we haven't answered. I'll hand it over to Zane to maybe try to wrap up. I'll try to do some TA before we wrap up before 9 o'clock. So Zane,
Thanks, Jonathan. I'll just share my screen to do some TA for now. Okay, so the first question I see is about regarding Dell. So for Dell, I think it's rather range bound for now, but I think some positives is that since the retest of this blue uptrend support line recently, price has remained above this recent resistance breakout at $142. So I think as long as this price continues to hold as support, there should be some upside in the near term, as long as when price breaks above this 150 level, you might see a retest of these highs at around 161 to 162. Then the next question is on HP. So for HP, something a bit similar or currently in the range. This week we saw price regain back above this key level of 35.40, which was a previous support, and there was a breakdown, price consolidated over here, and then recently we see some strength again. So I think with that, price should be able to go up to retest this key level next at 37 first, and then we might enter into a bit of a range consolidation again. Next one is on AT&T. So AT&T, I think it's quite bullish when you look at the longer term chart. Price actually is broke out of this key resistance at $18.50, and then currently it's still holding at this level. So I think we should be able to see some further upside going ahead. Next key levels, first up will probably be this price gap fill over here where price previously gap down there about $19. The next one up probably be about close to $20 will be the next level for AT&T. Okay, I'll just take one more on the three US Bank, JP Morgan, Wells Fargo, as well as Bank of America. So JP Morgan, I think is still very strong. It's at new all-time highs, and then price is holding consolidation above the previous high of $205. So if that should be able to continue to see some upside ahead. Yeah. But you know there's earnings that will be come out, and that will affect the price movement as well. Next one is Bank of America. Bank of America moving nicely after the breakout of this ascending triangle over here, breaking out the resistance at $40.30. So I think with that, it's approaching the next resistance level, which is around 40. It's around $42, which was a previous swing high back in March 2022. Next key levels I think we can look out for is around $43.50, then followed by $45 is the next resistance levels. Yeah. Then last one on Wells Fargo. Okay, Wells Fargo, I think it's moving nicely as well for now. Even though it's not as strong as the previous two. Recently we see some price recovery with this double bottom being formed at 56.70. Price broke out the neckline resistance at 59, and then there was a retest of this week and price held above it. So if that we should be able to see continue on this bullish reversal. Next key level up would be the recent highs at around $61, then followed by the next high at around $62.50, about there. Yeah, so that's it for the TA for me. I'll pass the time back to Jonathan to conclude today's session. Thanks.
Yeah, thanks, Zane. Yeah, so sorry that we couldn't answer all your questions. But feel free to post them in our P3 community. Or if you're not in P3, you can also just send us an email with the questions, and we'll try to answer it and get back to you as soon as possible. Yeah, so thanks everyone for joining us. With that, I'll hand it back to Juan to close us off. Thank you.
All right. Thanks again once again to our speakers for the presentation and the interactive Q&A. So we have now come to the end of the webinar, and I would like to thank everyone for joining in this evening session. All right. So for the session just now, we'll be uploading the slides recording on the PhillipCapital YouTube channel. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every day. So you can view our full list of free webinars on our website under education. All right, do take your time to fill in the survey so you can improve your experience with us in the future. You can also scan the QR code on the screen to actually access the link faster. All right, so you can actually join us also in our investing communities. All right, to get free access to the free research reports and discussion on the technical analysis, you can actually join this particular community group. Just scan this particular QR code. If you miss it, you can view the QR code again on the recording itself. All right. So once again, thanks all for joining, and then we hope to see you tomorrow. Tomorrow we do have speakers for our Hong Kong market, right? So we have it at 10 to 12 p.m. itself, 10 a.m. to 12 p.m. All right. So do join us if you are free. All right. Thank you very much, and have a nice day ahead.